With a 35% recession probability hanging over 2026, growth stocks are getting hammered while defensive sectors are quietly outperforming. I'm repositioning my portfolio before April, and I'm going to show you the 5 defensive investments I'm actually buying, why April is the strategic deadline, and how much of each sector belongs in a recession-resistant portfolio. Let's get into it. Here's what's happening in the market that most people are missing. While tech stocks are down nearly 22% year to date and the S&P 500 has fallen 18% from its peak, consumer staples are up 13%. Energy is up 19% and utilities are only down 1.5%. That's not a coincidence. That's capital rotating from growth to safety. That's professional money managers looking at the same recession possibilities we talked about and moving billions into defensive positions before the crowd catches on. JP Morgan puts recession odds at 35%. UBS is calling for over 90% probability in the near term. The unemployment rate just hit 4.6%, the highest in 4 years. And the market is voting with its feet, moving into sectors that perform regardless of economic conditions. And here's what makes this rotation so critical. Historically, by the time the average investor realizes they should be defensive, the easy gains are already gone. The time to position defensively is before recession is confirmed, not after. In April, that's when the Fed is expected to make its next rate decision. That's when Q1 earnings reports hit and when we get clarity on whether corporate guidance is getting slashed. And that's when recession fears either materialize or fade. But here's the key insight. Not all defensive investments are created equal. Some sectors claim to be recession resistant, but still get crushed when the economy contracts. The 5 I'm buying have historical track records of outperforming during downturns, and they're showing relative strength right now in early 2026. Defense number 1, utilities, the backbone play. Utilities are boring, and that's exactly why they work. People don't stop using electricity when the economy struggles. These are non-discretionary expenses with government-regulated pricing. NextEra Energy is my pick, world's largest generator of wind and solar, positioned at the intersection of baseline electricity demand and the AI data center power boom. Projected EPS growth of 7.6 to 7.8% annually. When most companies see earnings contract in recession, that steady growth becomes gold. The stock yields around 2.4% with 31 consecutive years of dividend increases. Plus, falling interest rates make utilities more attractive. Their yields look better relative to bonds, and infrastructure borrowing costs decrease. Plus, falling interest rates make utilities more attractive. Their yields look better relative to bonds, and infrastructure borrowing costs decrease. Allocation, 15 to 20% of defensive portfolio. Now, the most defensive real estate play? Defense number 2, REITs, but not all real estate. Real estate can be tricky in recession. Commercial, office, and retail get crushed, but certain REITs are counter-cyclical. They benefit from economic stress. Public storage is my pick. Self-storage demand is driven by life events, downsizing, job changes, relocations, divorces. These happen more during recessions. People lose jobs and move to smaller places. They need storage. Companies cut office space. They need storage. PSA has pricing power and the strongest balance sheet in the sector. REITs must distribute 90% of income as dividends. Public storage yields around 4.2% right now, and I'm also watching Digital Realty for data center exposure. DLR owns the physical infrastructure powering cloud computing. Companies don't cut AWS or Azure spending in recession. They increase it for efficiencies. It's a utility disguised as a REIT. Combined REIT allocation, 15 to 20%. But here's the sector showing strongest momentum. Defense number 3, consumer staples, the necessity trade. Consumer staples are up 13% year to date, while tech is down 22%. That 35-point spread is capital rotation in real time. Staples sell regardless of conditions. Toothpaste, toilet paper, food, beverages. You don't stop brushing teeth or eating in recession. And demand for staples like food and alcohol actually increases during downturns. My picks, Procter Gamble, Coca-Cola, and Costco. And P&G owns Tide, Pampers, and Gillette. Crest, Dawn, Bounty, non-negotiable household purchases, returning $15 billion to shareholders in fiscal 2026. Yield 2.4%. Decades of dividend increases. Coca-Cola serves 2 billion customers daily across 200 plus beverages. During the 2007 to 2009 recession, sales fell only 5% while stock outperformed S&P by 24 points. 63 consecutive years of dividend increases. 80% of sales from outside the US. Costco's membership model creates locked-in recurring revenue. 93% plus renewal rate means cash flow continues in recession. People still need groceries, and bulk pricing becomes more attractive when budgets tighten. Consumer staples allocation, 25 to 30%, my largest position. Best risk-adjusted returns during recessions. Now the sector with downside protection and upside optionality. Defense number 4, healthcare, the non-discretionary medical play. Healthcare demand is non-discretionary. You can't defer cancer treatment or skip blood pressure medication because the economy is bad. Stable, predictable cash flows through any environment. Johnson & Johnson is the anchor, diversified across pharmaceuticals, medical devices, consumer health. When one segment faces pressure, others compensate. Fortress balance sheet, consistent dividend growth, reasonable valuations. Healthcare stocks typically decline less than the market during recessions. Not recession-proof, but recession-resistant. J&J yields around 3%, over 60 years of dividend growth. Healthcare allocation, 15 to 20%. In the final piece, defense number 5, Dividend Aristocrats ETF, the diversified backstop. ProShares S&P 500 Dividend Aristocrats ETF holds companies with 25 plus consecutive years of dividend increases. These companies survived 2001, 2008, 2020, and every recession in between, and still raise dividends every year. Current portfolio, 66 companies across defensive sectors. Diversification, quality, 2.1% yield, 0.35% expense ratio. Ultimate defensive diversification without picking individual stocks. Dividend Aristocrats allocation, 15%. And here's how this actually gets deployed. Here's the breakdown of my defensive positioning. 30% consumer staples, P&G, KO, COST, 20% utilities, NextEra Energy, and 20% REITs, public storage, digital realty, 15% healthcare, Johnson & Johnson, and 15% Dividend Aristocrats ETF. That's 100% defensive, but this isn't my entire portfolio. This represents 40 to 50% of my total investable assets. The other 50 to 60% stays in diversified index funds and growth positions. Why 40 to 50% defensive? Because I'm not trying to time the market perfectly. I'm not predicting recession with certainty. I'm positioning for protection while maintaining upside exposure. If recession hits, my defensive positions cushion the fall. If the economy powers through, my growth positions still capture gains. This is about risk-adjusted returns, not abandoning the market. April brings 3 critical inflection points. First, the Fed's next policy decision. Rate cuts favor defensive sectors, particularly utilities and REITs. By April, we'll have clarity on the pace and magnitude of cuts. Second, Q1 earnings season. If companies are slashing guidance and missing estimates, defensive rotation accelerates. You want to be positioned before that guidance comes out, not after. Third, tax season liquidity. People get refunds, rebalance portfolios, and make allocation decisions. This creates volume and volatility. Being positioned before that wave hits gives you better entry prices. After April, if recession fears are confirmed, defensive stocks will already be bid up. You'll be buying at premiums instead of discounts. Don't buy everything at once. Dollar cost average over 4 to 8 weeks to smooth entry points. Start with highest conviction positions, consumer staples and utilities. Layer in REITs and healthcare. Finish with Dividend Aristocrats ETF. Set up automatic dividend reinvestment on all positions. Use that cash flow to compound. Don't sell growth positions to buy defensive. Add defensive as new money comes in, or gradually rotate. Abrupt portfolio changes usually end badly. Defensive stocks won't make you rich quick. They won't 10x or be the exciting party story, but they'll decline less when markets crash. They'll pay dividends that compound. They'll let you sleep at night. And during 2008, consumer staples outperformed the S&P 500 by 20 plus points. During 2020, utilities and healthcare provided stability while everything collapsed. This isn't about getting rich. This is about not getting poor. And in recession, not getting poor is how you build wealth. A 35% recession probability means 65% chance we avoid it. And I'm not betting everything on one outcome. I'm building a portfolio that works in multiple scenarios. Consumer staples are already up 13%, while tech is down 22%. That rotation is happening now. April is when it confirms or reverses. Subscribe because I'm documenting every position, every adjustment, every lesson. And check out this next video for more tips. Then stop watching and start positioning. April is coming.